meltdown of each of these markets, whether it's emerging markets, whether it's munis, people are just running away from risk and running to treasuries and saying, I don't care if I'm going to lock in a loss, I just want my money back. And what that creates is actually, for long-term investors, a really nice opportunity. One of the things that we actually like right now is the paper of finance and bank companies. All the names that are in the news that might make you cringe. JP Morgan, Citi, Wells, Wachovia, Morgan Stanley. We have seen what the U.S. government is going to do. They just took, all of us as taxpayers, we just took equity positions in those finance company names. Citicorp had to go through a second type of bailout just by Thanksgiving. What is really been described by the government is that, you know, we're going to build an umbrella, and I actually have a page in here with that theme, and certain organizations will be under that umbrella. That's how we want to invest. Right now, you can buy those bonds that of all those companies I just mentioned at 6 or 7% over treasuries. Now, normally these things trade about less than 1% over treasuries, about 90 basis points. And so we're comfortable that these are the organizations that will be bailed out. And it's a strategy that certainly, you know, some might criticize, hey, you're trying to take advantage of the government. But those are the yields. This is what the government wants you to do. They want you to invest in these types of securities. They're laying down the signal that it's okay, because guess what? We're all in it together as taxpayers. So that's one theme we have. Another theme we have right now is Fannie, Freddie, and Ginnie. All names that today, again, depending on your level of involvement in the market, might make you cringe. But you have to remember the mortgage market really got washed away with the idea of subprime being in the news. But what is true is that the normal Fannie, Freddie, and Ginnie conventional loans that were made to borrowers that had to have 20% down, borrowers that had to have prime credit scores, borrowers that verify their W-2 and their income, and have historically, with that good credit score, been people that pay their mortgage, those bonds also have been thrown out with the bathwater. So right now you can get about 250 basis points over treasuries in a Ginnie, Fannie, and Freddie. And normally those bonds trade at 70 basis points over treasuries. Again, these opportunities are remarkable. And you know, it's something that we're excited about for investors. But when I go into some meetings, and I know that's not the case here, Jim and I discussed, that your bond manager is doing a good job at this point, but a lot of people are not in your situation, and in some cases they're scared to take advantage of this. But what we're trying to do is stay close to the handle of the umbrella. And if I could maybe actually have you visualize this on 16. Again, this page here shows the agencies of the government that are building the umbrella. You have the symbols for the Fed, the Treasury, and Congress. And we want to be as close to this handle as we can be, because it's a hurricane out there. People on the edges are getting wet. People not on the edges are the people that are drowning, like the recent hedge fund blow-up that happened this week. But we want to be in here. But what's remarkable is you can be in here and you can get some returns. And that's what I wanted to make sure you realize about the bond environment today. Let me pause there, see if this has created some questions. I have a couple other points to make, but you know, going on a little while. Anybody have questions to this point?
I think you're making fabulous statements that need to be heard in this community.
Great, thanks.
Very good job.
Let me take you to 17, one past where we are. And this is back to the point of why would we be comfortable with these names. I want to make sure you understand our thinking. This is your first meeting with us. What I have here is a very colorful chart, but also notice it's very inconsistent. You see all the names listed here, starting with Bear Stearns, Fannie and Freddie, and all the other names. Why did the crisis get as bad as it did? And what's interesting is you look at back to March when Bear Stearns went down. You know what happened? I have this split up with bondholders and equity holders, bonds versus stocks. Of course, the stockholders got hurt pretty bad. Remember, the idea was that it was going to be sold for $2 a share, and then over that weekend they said, well, we'll make it $10 a share when JP Morgan took them over. So stock people were not even bankrupt. They at least got something, and all the bonds were okay. Next crisis, Fannie and Freddie. They went into conservatorship in September, early September, pre-Lehman. The equity holders got wiped out. If you were a holder of Fannie or Freddie stock, good night. It was over, okay? But the bondholders, okay. Lehman, the next week after that, the feds let them go. There was no bailout. There was no effort. There might have been an effort, but it certainly didn't happen. Everybody gone. Everybody suffers. Merrill Lynch, the same week, gets taken over by B of A. Everything's green. AIG, now this is an interesting one. The stock's cratered. It's not worth much at all. But now all of us, again, are 79.9% owners of AIG because the government is now owners of AIG. And so it's debatable, are we going to get our bonds back? Nobody knows. The bonds have traded as low as 15 cents on the dollar, and now they're at 60 cents on the dollar. And so that's yellow. The next one, WAMU, gone. No rescue there. And then Wachovia, complete rescue by Wells, all green. So the inconsistency here was a shock. In fact, we had an internal term for this, and maybe you go to the fair and you know this game called whack-a-mole, where a mole comes up and you don't know what to do, and that was the reaction that the investing public saw from the officials of this country. So lo and behold, after all this comes the TARP, which had its own problems of being first declined and then rejiggered, and Paulson's messed around with it. But the things that are going on now in the response by the government, the building of that umbrella, are starting to work. In the equity market, you don't see it as much, but in the bond market, we had a complete freeze of money market securities in September and October. One of the plans that the government came out with was geared towards the issuers of commercial paper. Companies like GE, John Deere, Caterpillar. They couldn't roll over their commercial paper. They could not borrow to pay their factory electric bills, payrolls, etc. because money market funds said, no thanks. We're just going to buy treasuries. So the government set up a program that actually PIMCO runs. One of the things, we got hired by the U.S. Treasury to run a commercial paper program for them where the government is buying directly from all those companies I just mentioned. And so now there's a buyer of last resort, and so that's starting to, the pipes aren't flowing, but there's a little bit of a drip, a thaw coming, and right now it's still in a very precarious situation because nobody wants to go over the end of the year without showing a beautiful portfolio that has all treasuries in it, right? Because you want to come into January and say, oh, well, we held treasuries and so on. But so there's a lot of window dressing going on right now. But as soon as the year ends, we expect that trickle to get a little bit better. And so the money markets are starting to function. The ideas that we addressed on page 16, the TARP, et cetera, are starting to work. But let's face it, it gets a lot of bad press because the equity markets are still in a crazy environment. But bonds a little bit better off. There are a couple last pages I'll touch on, and then again, certainly questions could be asked if you have any. I wanted to show you on 13 what our record is on this downside again. Here I'm showing back to the inception of the total return fund, and